Stocks are rebounding from yesterday's late sell-off. The Dow, S&P, NASDAQ all higher, and bond yields are lower after softer inflation and GDP data this morning, with markets expecting a dovish PCE print tomorrow. And while everyone talks about the year-end Santa Claus rally, there are three catalysts looming in January that could also keep this market moving higher. Here to explain and maybe debate are Kevin Mahn, Chief Investment Officer at Hennion Walsh, CNBC's very own Dominic Chu, and we're also joined by Stephanie Roth, the Chief Economist at Wolfe Research. Welcome, one and all. Dom, first just outline for us some of the maybe positive surprises could be around the corner.
One of them or two of them are kind of consensus ones that have happened and carry over into next year from this year. And one of them is maybe a contrarian type play opposite of what we saw this year. So point number one is the world's second biggest economy, China. It's been an underperformer so far this year. They've had their economic problems. There's no doubt about it.
Right.
But could there be a scenario where the economic data starts to show some signs of life in China? We saw it with November data out with regard to manufacturing and tech manufacturing. That could be a big point there. The second one is about an earnings catalyst. Right now, the consensus, as tracked by LSEG, is for fourth quarter earnings growth in the S&P to be about 4.7%. Not bad, and we saw better numbers in Q3 as well. That could be a catalyst. Remember, earnings season starts just about a couple weeks after the new year does.
Right.
And then number three, and this is an interesting one because it's just seasonality. Generally speaking, November, December, January have been good months for the stock market overall. If you look at data from the Stock Traders Almanac, over the last several decades, on average, the S&P 500 is up about 1.1% for the month. It doesn't seem like a lot, but it's a pretty good performance for the month.
12% annualized, sure.
Yeah, for the month, right. And in fact, the NASDAQ, it's actually the best month of the year for the NASDAQ overall. It's up about 2.7% during the month of January. So we're talking about seasonality, maybe China, earnings catalyst, three potential ones that could push the market higher.
Kevin, do you think that's all priced into this kind of Goldilocks outcome in the markets right now?
I do. I think the overall macro theme for 2024 is going to be an expansion of the rally, a rally for the rest, if you will, beyond just those 7 large cap technology stocks that drove stocks higher in 2023.
The Steve Case thing, the rise of the rest, you know. But
the rise of the rest, very well said.
For the stock market.
But for that to take place, we really need to move past, we're at the end of this rate hike cycle, and need to move into now we're starting to get interest rate declines. And that's going to happen once this economic slowdown comes to fruition. And we learned from the Federal Reserve last week that they're now forecasting economic growth of just 1.4% next year, and economic growth staying below 2% for the next 3 years.
Yeah.
Silver lining to all that, they're going to have to cut rates probably sooner than many are anticipating, by more than many are expecting, and that leads to opportunities in stocks.
That's actually the perfect opening to bring Stephanie in, because she's not quite with there's, I think, 6 rate cuts priced in now. But Stephanie, you're thinking maybe we only get 3 next year. Is that right?
Yeah, that's right. But if we get 6 rate cuts next year, that would mean the economic backdrop's pretty bad. Yeah. 3 rate cuts, I think, is certainly more consistent with what the Fed's saying, and that would be in an environment where inflation's coming down back closer to 2%, which, by the way, it already is, and growth is remaining okay. So, and that would mean just the market would have to just push out the rate cuts. And by the way, the market's only expecting the Fed to get back down to a little bit above 3%. We expect that the Fed will ultimately cut down towards about 275. So that's where the rest of the rally in the 10-year could come from.
Wait a minute. So you're thinking fewer rate cuts, but you have a lower terminal rate?
Exactly.
Wait, so when are the rest of the cuts coming? 2025?
Yeah, exactly. We expect it'll be a more modest cutting path where the Fed's cutting once a quarter, every other meeting, until they get back down towards that 3% in the next couple of years.